Hey class, it's Dr. White here with your knowledge check. And this knowledge check is about chapter 1 in your textbook. So, some of the things I want you to remember in this course and in practically all the accounting courses that you're going to take, except for managerial accounting focused courses, we're going to be looking at GAAP. GAAP stands for Generally Accepted Accounting Principles. And those are the set of rules that we use to record financial transactions um, in accounting records in the US. And there are some countries that also use GAAP. Okay. So remember that. That's very important. The accounting equation, part of your knowledge check. Remember, assets equal liabilities plus equity. All right. So you're going to have your assets. Again, those are found on your balance sheet and usually presented on the left-hand side of the balance sheet if it's a side-by-side balance sheet, or it's presented at the top of the balance sheet if it's a stacked balance sheet. Okay. Then you have your liabilities and your equity, which appear on your right-hand side of the balance sheet if you're doing a side-by-side balance sheet, or at the bottom of your balance sheet if you're doing a stacked balance sheet. Assets are those items, those financial items that the company owns and that they bring benefit to the company and they help the company generate more revenues and more profits. All right. So cash is an asset because the company owns its cash. Buildings that the company operates out of. Those are assets. Accounts receivable. All right. You'll learn about accounts receivable. Accounts receivable, if you haven't gotten to that concept yet, those are amounts that people owe to the company. So basically, the company owns those debts. The company is owed that money. So that is an asset to the company as well. If the company has any land, any vehicles, those are assets. Inventory, if it's a company that resells items, it'll have what we call inventory items, the items that it's actually going to sell. And before the company sells those items, it owns those items. And so those are considered assets as well. All right. And then we have liabilities. Liabilities are those financial items that the company owes to other people. All right. So, for example, if the company has a loan with the bank, the company owes that money to the bank. That is a liability, and that appears on the balance sheet on the liability side. And then we have equity. Equity are the shares that the company issues to shareholders. All right. And those are recorded under the equity side of the balance sheet. So again, assets equal liabilities plus equity. Also, for purposes of this course, we're going to be looking at the income statement. We're going to be looking at the statement of retained earnings. We're going to be looking at the balance sheet, and we're going to be looking at the statement of cash flows. Those are the primary financial statements that we are going to be reviewing in this course. What else do I want you to remember for this class? In your financial statements, I just talked about the ones that we're going to be looking at, which are your income statement, your statement of retained earnings, your balance sheet, and your statement of cash flows. Remember, on your income statement, revenue minus expenses, that gives you your net income. All right. On your statement of retained earnings, you typically have your beginning retained earnings. You add your net income, which you take from your income statement. You subtract out any dividends, and that gives you your ending retained earnings. And your balance sheet, as I mentioned, gives you your assets, which are equal to your liabilities plus your equity. And then your statement of cash flows, you're going to have your changes either coming in or going out, money coming in or going out for your operating activities, for your investing activities, and for your financing activities. And we'll go through those in more detail as you move on further in the course. Not sure if it's covered in this particular chapter, but I do want to point out something very, very important that for debit, every single debit, there's a corresponding credit, and the two must equal. And you can make several debits, you can make several credits, they must equal. So, for example, if you make a debit for $100, you can make two credits for $50 each, but the credit must correspond to the debit and the amounts must equal. So, that's a very important concept that a lot of students tend to forget. Anytime you make a debit in accounting, you must make a corresponding credit. Right? That's your knowledge check for chapter one. I'll be back again with chapter two.